In this video, I'm going to discuss net unrealized appreciation and how it is a tax tactic that can potentially help you save a significant amount of money on taking distributions from your 401k or retirement plan if you own company stock in that plan. Welcome back. This is episode 195. This week, I'd like to talk to you about a special tax treatment called net unrealized appreciation and how it could save you a significant amount of money when you begin to take distributions from your 401k or your retirement plan. I'd like to talk to you about how you can take advantage of it and the things you need to be aware of if you want to consider it. But before we get into that, as a reminder, if you're serious about getting a plan in place for retirement, then consider signing up for my online retirement planning course, Retirement Readiness Review. It's an on-demand course where I educate you on what you need to know about planning the ideal retirement. We discuss taxes, Social Security, Medicare, investing, estate planning, and much more. To learn more, head over to retirewithryan.com and click on courses. So net unrealized appreciation is definitely an overlooked tax planning tactic that people are not aware of when they begin to retire and take distributions from their 401ks. They're also generally not aware of it as they're managing the money they have in their 401k, and sometimes also not aware of it when they begin to do rollovers from their 401ks. So what is net unrealized appreciation? Well, if you work for a company and you own stock in that company, or it's a publicly traded company, and you're investing in that stock, let's say you're invested in CVS stock, for example, and you have some of your 401k that you've been investing in CVS stock. Well, you could potentially pay long-term capital gains rates on the portion that you have in that CVS stock, as opposed to taking it out as a distribution of cash and paying ordinary income tax brackets. So that's where the significant tax savings could come into play. And right now, we currently have the ability with our tax code to even pay 0% tax on long-term capital gains rates for single filers or joint filers or married or head of household filers who find themselves in the lowest two tax brackets. So if you have capital gains and that puts you in the 12% bracket or below, those capital gains can be taxed at a rate of 0%. So what has to happen for you to take advantage of this? Well, you have to have a triggering event, and those triggering events are death, disability, and separation from service, or reaching age 59 and a half. So death is obviously not benefiting you, but if you pass away, if someone inherits your retirement plan, be it a spouse or someone else, they could possibly take advantage of this. With disability, if you go on disability, that could be a triggering event, or separation of service would be if you leave the company and you're no longer working there. Also, reaching age 59 and a half can be a triggering event. So let's walk through an example of how this would work. So let's say, for example, you do work for CVS and you've been purchasing CVS stock that was formerly Aetna over a number of years. And you currently have a balance in your 401k of $500,000 and $100,000 was CVS stock that you paid $10,000 to buy over time. So you have a $90,000 gain on your stock. That $90,000 gain is what is eligible to be taxed as long-term gain rates. So that $90,000 gain could be taxed as low as 0% if you were able to take advantage of the 0% tax brackets on capital gains. And we'll talk about that in a minute. But let's say worst case, you're able to pay 15% on that $90,000 versus 22% federal tax. That is a significant amount of tax savings. But let's just say you were able to pay 0%, and instead of paying 22% federal tax on that long-term capital gain, that $90,000, that would be $19,800 of federal tax. And if you're also living in a state where there's state income tax, let's say that was state income tax of 5%, that's another $4,500. So that's about $24,000 of taxes that you would pay if you just took that $90,000 out and it was taxed as ordinary income, not as a long-term capital gain. So that's where the significant amount of tax savings could come into play. So how do you actually process this distribution? Well, as I said before, you have to have a triggering event. So let's just say that triggering event was retirement. You retire from CVS or whatever company you work for, and at that point, you would then need to roll over your 401k to an IRA. Now, when you process the rollover, that stock, whatever the portion of the stock is that you're going to use to take advantage of net unrealized appreciation, you separate from the rollover. So that stock gets usually sent to a brokerage account, and the rest of the money gets rolled over to an IRA. Now, the IRS requires for you to take advantage of this that you roll over the entire balance of your retirement plan by the end of the tax year. That's where some people can trip themselves up. They either don't realize that and they don't completely roll over the money. Maybe they only distributed the stock, but you have to completely roll over the account. So it's a good idea not to start this at the very end of the year, like in December, where you might not have time to process this. It would be a good idea to start this with at least a couple months probably of lead time to make sure if there's any issues, you can solve those issues. So you let your 401k provider know when you're doing your rollover if you want to take advantage of this. And they use the process that they have to set up an account for that company stock. Sometimes it's set up directly what's known as the transfer agent. That's the company that maintains the records for company shares. And then from there, you can decide to leave it there or transfer it to a brokerage account. And then the cash, the remaining money that's not getting sent out as a stock distribution gets rolled over to an IRA. So you need to open up an IRA at a financial institution to be able to roll that money into it. Now, the basis in the stock is going to be taxed as ordinary income in the year that you process the rollover. So let's just say in my example, the basis was $10,000. That'd be taxed as ordinary income in the year that you process the rollover. Going forward, the company stock that you're going to continue to maintain will only be taxed when you liquidate that stock. So you choose how you want to liquidate that stock. Whatever the difference is between your basis, in my example, $10,000, and your original price when you transfer the stock out is going to be taxed as a long-term gain. Any increase over that price from when you transferred it out will then be taxed as either a short-term or long-term gain. If you hold it for one more year after you transfer it out of your retirement plan, then any future gains will always be long-term. So where I see people run into problems with this is they either don't process the rollover all at once. That's one problem. Or I should say all by the end of the year. And therefore, that would disqualify you for being able to take advantage of this. Another issue I see is that people don't even realize this. So they go to process a rollover and they're not aware that they could benefit from this special tax treatment, and they just have the stock liquidated as part of the rollover. And that's fine. Maybe you don't want to take advantage of this, or maybe it doesn't make sense for you, but you should at least investigate that before you're doing a rollover and know whether or not you want to take advantage of this. Another issue or mistake people make is that they don't realize they could take advantage of this. And if, let's say, you owned this company stock for a long time, but you were concerned about the company and the stock started going down and you get out of it, well, now you've canceled your original cost basis. So if you decide later on to go back into the stock, your cost basis would start over again with whatever you purchase it for later on. Now, obviously, there's a lot of risk with owning one company stock. There's many examples that we can think of where the company stock has had problems and people have lost a lot of their retirement funds. But if it's a company that's a solid company and there's not a ton of fluctuation with it, and you'd feel comfortable holding it for a certain period of time to take advantage of this, then there could be a significant benefit. Let's just say in my example, instead of being a $10,000 cost basis, it was $100,000 that you paid for the company stock, and now it was worth $200,000. So you had a $100,000 gain. Well, in that case, if you did take advantage of this, you'd have to pay ordinary income tax on $100,000 in the year that you took the distribution. So that might make it not as worth it because you still have to pay ordinary income on $100,000. Now, you would be able to pay long-term capital gains rates on another $100,000, and there's definitely some tax savings there, but you have to weigh out whether or not it would be worth it to pay ordinary income on that basis in your stock. So anytime you have company stock in your 401k, you should investigate to find out what is your basis in that stock, especially as you're getting closer to retirement, to determine if net unrealized appreciation is something that you want to take advantage of. Now, I mentioned earlier about being 59 and a half. That's definitely a triggering event. But what if you're not 59 and a half and you want to take advantage of this? Let's use my previous example of having a $10,000 basis and a $90,000 gain. Let's say you find yourself at 53 years of age and you're leaving the company and you still want to roll over the money. Well, in that case, you would still be able to do this because you're separated from the company. However, your basis would be subject to a 10% early withdrawal penalty. So only $1,000 of taxes as a penalty. But if you had a larger basis, let's say back to my previous example of $100,000 in basis, now that would be a $10,000 penalty because 10% on $100,000. So that's something you have to consider if you want to do this before 59 and a half. Ideally, you would wait to do this until you were 59 and a half and you were separated from service from the company. Because both of those would allow you to qualify for the triggering event, and you wouldn't have to pay any early withdrawal penalties on your basis in the stock. But as I said earlier, having a lot of money in one company stock can be risky. So if you are retiring before 59 and a half, it could make sense to do this before that, because that would allow you to reduce the amount of money you have in the company stock and diversify your holdings. One other thing I'll mention is that within most 401k plans, they also allow you, if you take distributions between 55 and 59 and a half, to waive the 10% penalty. So really, it would only be a concern if you were going to be doing this before age 55, and you'd be potentially subject to the 10% penalty. So I hope this helps give you some idea of how net unrealized appreciation can benefit you. So definitely look into, if you own company stock in the stock company you work for, what your basis is in that stock, and keep an eye on that as you continue to manage your 401k and decide whether or not you want to keep that company stock until you have a triggering event, and you can then take advantage of this potential tax savings. So one other thing I'll mention is that everyone right now, as a reminder, if you can sell the stock when you don't have a lot of other income in any one year, and you can keep your income in the 12% bracket or below, that currently qualifies for a 0% capital gains rate. So that's where you have the ability to sell the stock and pay a 0% capital gain. You don't have to sell the stock all at once. You also could sell part of it over time. If you didn't have other income, that would be the ideal situation. Because what happens is any other income you have, whether that be Social Security, IRA distributions, earned income, or interest, fills up your 0% tax-free bucket first. So then any capital gains go on top of that. So you really would ideally only have capital gains in any year if you're trying to take advantage of that 0% tax capital gain rate, which could be a big benefit. So as always, if you have a listener question, feel free to ask that question by going to retirewithryan.com and clicking on Ask a Question. Have a great week, and I look forward to talking to you next Wednesday. Take care.